Today, we are looking at the absolutely incredible transformation of a beloved sandwich brand. We are going to explore how Jersey Mike's evolved from a tiny seaside shop into a highly leveraged business juggernaut. It is a story packed with brilliant business models, massive growth, and honestly, some pretty fascinating strategic decisions. I literally cannot wait to walk you through exactly how this company engineered such monumental success. Just think about this for a second. How exactly does a 17-year-old kid buy a local sub shop and turn it into a multi-billion-dollar empire? Well, the story starts back in 1975 with a high school senior named Peter Cancro. He boldly borrowed a substantial sum of money from his football coach, who also just happened to be a local banker, so he could buy the business. That one massive leap of faith set the stage for literally everything that followed. Okay, let's dive right into this teenage sub shop dream. The roots of his brand go deep into the sands of the New Jersey shore. It all started as a seasonal business meant to feed hungry tourists visiting the boardwalk from places like New York and Philadelphia. It was your classic, authentic, mom-and-pop operation that absolutely thrived on summer foot traffic. Mike's Subs originally opened its doors way back in 1956. By 1971, a 14-year-old Peter Cancro started working behind the counter, slicing meats and building relationships with customers. Just 4 years later, against all odds, he actually bought the entire shop. He spent the next decade meticulously perfecting the model before officially launching their national franchise program. But surviving the crisis that hit in 1991 was a whole different story. The journey to the top was definitely not a straight line. The long-term viability of the company was severely tested during a brutal macroeconomic recession. A sudden collapse in the commercial real estate market, paired with a systemic banking crisis, brought their expansion plans to a grinding halt. It was truly a make-or-break moment for the young startup. Facing a severe credit freeze, their liquidity completely dried up overnight. Unable to secure working capital, Peter was forced to lay off his entire corporate staff. It was a devastating blow. He was essentially left completely alone to figure out how to keep the company alive. So they immediately stopped all expensive outward expansion. Instead, they pivoted and launched targeted direct mail initiatives to their existing customer base. They literally pounded the pavement, conducting door-to-door marketing within a 1-mile radius of every existing store. They also capitalized on local radio appearances and strategic billboards to drive intense local awareness. This desperate pivot to low-cost grassroots marketing not only saved the business, but it created their permanent operational playbook for the future. Now let's take a look at the franchise royalty machine. Underneath the fresh-baked bread lies a highly tuned economic engine. This is where the startup really transitioned into a corporate powerhouse. We are going to look closely at how the modern company actually makes its money today. The absolute key to their massive success is their asset-light franchise model. To put it simply, corporate does not actually sell you a sandwich. Instead, they sell independent operators the right to sell you a sandwich. They generate incredibly stable, high-margin cash flows purely through royalties and fees while owning almost zero physical restaurants themselves. And this brilliantly illustrates the incredible dual nature of the brand. In the front of house, you get this romanticized, artisanal customer experience with fresh sliced meats and daily baked bread prepared authentic to their roots. But in the back of house, you find a highly leveraged corporate machine built entirely on intangible trade name value. It really is the perfect marriage of authentic hospitality and ruthless corporate efficiency. A major catalyst for their phenomenal growth is the massive volume of revenue each store generates. They boast industry-leading annual sales at the register for a single franchise location. This category-leading volume is exactly what drives intense demand from franchise owners who just want to open more and more locations. It absolutely proves that the unit-level economics are incredibly strong. When you break it down, the economics heavily favor the corporate entity. The franchisee takes on all the physical risks and costs, writing the big checks for the build-out, the equipment, the labor, and the food. Meanwhile, corporate clips a hefty, risk-free percentage right off the top of gross sales for royalties and advertising. Corporate takes a significant cut from every single register without having to fund the day-to-day physical store operations. There's also a very clever piece of strategic re-engineering happening right now. For years, the company used middlemen called area directors to help scale the system, paying them a lucrative slice of royalties in return. Now, corporate is strategically buying out these area directors with one-time cash payments. By doing this, they permanently reclaim that royalty slice and significantly boost corporate cash flow. Let's move to the Blackstone buyout and see how this story builds. All of these pristine unit economics ultimately attracted the attention of private equity. It set the stage for a monumental acquisition that completely changed the company's trajectory. This is exactly where the massive institutional money enters the room. The resulting valuation was absolutely staggering. Recently, the private equity giant Blackstone paid a multi-billion-dollar premium for a majority stake in the company. The primary goal of this massive investment is to rapidly accelerate global growth and drive digital transformation. It instantly turned a boardwalk sub-shop into a Wall Street whale. To lead this ambitious new chapter, they brought in a major heavy hitter. Charlie Morrison took over as the new CEO. He has an incredible track record, having previously served as CEO of Wingstop, where he aggressively multiplied their store count. He also successfully led their highly anticipated IPO, making him the absolute perfect leader to scale Jersey Mike's under private equity ownership. Now, let's take a look inside their upcoming public offering. This massive Wall Street transition reveals a lot when you look at the paper trail. We can find the answers by diving into their recently filed public prospectus. This document peels back the curtain on the financial realities of the brand. And let me tell you, there are some incredibly surprising facts buried in the fine print. What is really interesting here is the sheer scale of the cash moving around. The public filings revealed some massive governance red flags, including tens of millions of dollars in compensation paid to the founder's stepson in just a few short years. A massive corporate jet was also transferred to an entity controlled by the founder. On top of all that, the company is carrying billions in securitized debt, which was partially used to fund a massive dividend payout directly to Blackstone. Because of the buyout, the balance sheet now holds a massive multi-billion-dollar intangible asset for the brand's name. In stark contrast, they hold barely any actual physical, tangible assets. It is a brilliant illustration of how phenomenally valuable an intangible brand name becomes in a pure franchise royalty model. So what does this all mean for the future? This leaves us with one incredibly provocative final thought. Will Wall Street's relentless demand for aggressive growth and massive debt repayment destroy the authentic mom-and-pop quality that made the company so successful in the first place? Can the romanticized culture of this boardwalk sub-shop actually survive the intense pressures of franchise capitalism? It is a fascinating balancing act that every startup enthusiast should be watching very closely. Jersey Mike's has officially dropped its S-1 registration statement, and they are gearing up to list on the New York Stock Exchange under the ticker JMKE. Right now, institutional investors are tearing through this filing to reverse engineer the financial mechanics before the opening bell even rings. We are looking way past the branding and the sandwiches here to analyze the raw, unfiltered data. Because what this prospectus actually reveals is a highly complex financial architecture hidden right beneath those storefronts. It is a super rare window into the capital structure of literally one of the fastest growing chains in the entire country. Market participants are heavily focused on the exact balance sheet mechanics buried in these pages. The ultimate goal is to figure out if this public offering price actually aligns with the real fundamental value of the assets. Every single line item in this registration statement carries massive implications for how this stock is going to trade post-IPO. The anchor for this entire financial event is a staggering $12 billion target enterprise valuation. Private equity giant Blackstone and the company's founders are aiming straight for this premium pricing tier. And a valuation like that, it puts this offering in a highly exclusive multiple category for the fast casual dining sector. To put $12 billion into perspective, investors are looking really closely at comparable public market valuations. We're talking about brands like Cava and Chipotle that trade at serious premium multiples, and Jersey Mike's is trying to price itself right into that elite club. But pulling off that valuation requires a nearly flawless operational narrative to justify the implied forward earnings multiples. It basically suggests the underwriters believe public markets are willing to pay a steep premium for the chain's historical growth trajectory. So the core question for institutional buyers is whether that $12 billion figure actually leaves any upside on the table for new shareholders. To support a valuation like that, the targeted capital raise sits at roughly $1 billion. In a market environment that has seen a serious dry spell from major restaurant IPOs lately, this number really stands out. In fact, it ranks as one of the most high-profile restaurant public offerings we have seen in 2 decades. The fast casual sector has been absolutely hungry for new, scalable concepts, especially after the massive success of the Cava offering. But a $1 billion float requires significant institutional absorption on day one of trading. This level of capital raise demands heavy participation from mutual funds, pension funds, and large asset managers. The underwriters are going to need to build an incredibly strong order book to support a liquidity event of this size without causing price destabilization. This offering is essentially going to serve as a major bellwether for consumer discretionary appetite in the public markets. Let's look directly at the pricing mechanics outlined in the SEC filings. The company is offering just over 43.48 million Class A shares to the public. The initial price range is currently set between $21 and $25 per share, and at that $23 midpoint, the math gives us a really clear picture of the sheer scale of capital that's changing hands. However, it is absolutely critical to calculate what this float actually means for initial trading liquidity. By offering around 43 million shares, only a tiny fraction of the total equity is actually being sold to the public. This creates a relatively tight initial float, which, as you know, can lead to heightened volatility in those early days of trading. Institutional investors are modeling this exact dynamic right now to nail down their entry strategies and position sizing. This sheer scale brings us to a crucial question that really defines this entire offering. Are public investors being offered a meaningful seat at the table? Or are they simply funding the exit liquidity for private equity and the founders? To answer that, we have to weigh a highly scalable franchise growth engine against a capital structure that heavily favors insiders. This is the fundamental tension embedded in almost every leveraged buyout that transitions back to the public markets. On one hand, you have robust cash flows generated by thousands of incredibly successful retail locations. But on the other hand, you have previous massive capital injections that are demanding a profitable exit mechanism. The S-1 filing allows us to completely separate the operational reality of the business from the financial engineering of its ownership. We really need to analyze the exact mechanics of how this capital is being deployed post-listing. The primary bull thesis for institutional buyers begins with unpacking that growth engine. There is a very clear fundamental reason why the market is initially so eager to buy into this specific equity. The operational data presented in the S-1 demonstrates some really exceptional execution over the last half-decade. Wall Street is constantly searching for repeatable, scalable business models with proven, undeniable customer demand. And the data suggests that the underlying business operations here are just firing on all cylinders. Institutional capital is deeply attracted to predictability, and the historical metrics show a highly predictable expansion rate. We are looking at unit economics that consistently outperform broader fast casual industry averages across the board. This operational momentum is the exact core asset that the underwriters are monetizing in this public offering. Just look at this. Between 2020 and 2025, the chain achieved a 50% cumulative same-store sales growth. That metric is an absolute outlier in the quick-service restaurant space. Same-store sales growth, or comparable store sales, is the primary indicator of brand health and customer retention. Achieving a 50% cumulative increase over a 5-year period indicates some massive market share capture. It proves that existing locations are actually becoming more profitable over time, rather than the company just relying on new store openings to artificially pump up revenue growth. This specific metric serves as the absolute primary driver of institutional interest right now. Investors view sustained same-store sales growth as hard proof of pricing power and strong average unit volumes. It signals that the consumer base is willing to absorb price increases while maintaining their transaction frequency. And that top-line growth is translating incredibly efficiently to the bottom line. In the first quarter of 2026, the company reported an impressive 45% adjusted EBITDA margin. Now, a 45% adjusted EBITDA margin is exceptionally high, specifically because it operates under a franchise model. When you contrast this with company-owned models like Chipotle, the margin profile looks entirely different. Company-owned concepts carry the heavy burden of direct labor, real estate leases, and all those localized operational costs. This franchise structure essentially completely isolates the corporate entity from a lot of those inflationary pressures. This really showcases the extreme strength and discipline of their unit economics at the corporate level. High-margin businesses with this level of top-line growth typically command the absolute highest premiums in the public markets. Understanding how they actually generate these margins requires looking at the exact structure of their real estate and operations. It all comes down to a highly scalable franchise model combined with incredibly low corporate overhead. Over 98% of the total store base is owned and operated by independent franchisees. They manage to maintain relentless operational consistency across locations while generating really strong recurring revenue streams through franchise royalties. This structure allows them to sell billions of dollars in sandwiches while owning almost none of the actual physical stores. The corporate entity functions a lot more like an intellectual property and supply chain management firm rather than a traditional restaurant operator. This asset-light approach severely minimizes the capital expenditures required for new unit expansion. It allows free cash flow to scale rapidly as the new franchisees take on all the risk of the local store build-outs. This operational strength is exactly why analysts are finding the bull case so compelling. Lucas Muehlbauer, a research associate at IPOs, noted that this is a very straightforward story for public investors. He points directly to the easy-to-understand franchise business, the reported revenue expansion, and of course the formidable backing of Blackstone. It is a pristine operational narrative that aligns perfectly with exactly what growth-oriented mutual funds are looking for. The pure simplicity of the model makes it incredibly easy for analysts to forecast future earnings. When you combine those predictable royalty streams with aggressive store count expansion, the forward financial models look highly attractive. Plus, having the endorsement from major private equity further validates the underlying unit economics to the broader market. This is the exact narrative the roadshow is heavily relying on to build institutional demand. However, analyzing an IPO requires looking way past the income statement and digging into the balance sheet. That pristine 45% adjusted EBITDA margin sits directly across from a very heavy $2.1 billion debt load. This structural reality immediately and completely changes the risk parameters for potential public shareholders. High debt levels inherently increase the equity risk premium required by institutional analysts. So while the operating margins are undeniably strong, a massive portion of that cash flow must be diverted just to service this debt. The balance sheet is highly leveraged, which, sure, is standard for private equity-backed exits, but it introduces strict financial constraints. In a higher interest rate environment, carrying $2 billion in liabilities becomes a material drag on earnings per share. This is right where the structural risks of the offering really begin to emerge for secondary market buyers. To truly understand the origin of that debt, we have to look back at the company's recent history. Private equity giant Blackstone recently paid $8 billion to acquire a majority stake in the company. That leveraged buyout utilized significant debt to finance the acquisition of the founder's equity. This transaction is what set the stage for the heavy financial structure we are looking at today. The debt was not taken on to build new stores or fund operational expansion. It was utilized purely as a mechanism to facilitate a change in ownership and provide liquidity to early stakeholders. Understanding this distinction is absolutely critical for evaluating the company's forward-looking capital allocation strategy. Public investors are essentially inheriting the exact financial architecture designed during that buyout phase. As the company enters the public markets, it is carrying that entire $2.1 billion burden. Servicing that debt requires significant cash flow, which directly impacts the debt-to-EBITDA leverage ratio. A high leverage ratio severely restricts the company's financial flexibility in the event of any economic downturn. Capital that goes toward interest expense is capital that literally cannot be deployed for dividends, share buybacks, or strategic acquisitions. The exact interest expense on this debt facility will heavily dictate the ultimate net income available to common shareholders. It completely changes the risk profile of the investment when you compare it to an unlevered competitor. Analysts are going to closely model the company's ability to deleverage its balance sheet over the next 8 to 12 quarters. The speed at which they can pay down this principal is a major factor in determining long-term equity value. This financial architecture extends directly into the governance structure of the newly public entity as well. The offering features a dual-class share structure, which creates a significant disparity in voting rights. Because of this structure, Blackstone essentially retains majority voting control over board elections and strategic direction. The company will actually qualify for the controlled company exemption under exchange rules. This exemption allows them to completely bypass certain standard corporate governance requirements, like having a fully independent board of directors. Public investors will essentially lack any real strategic influence over the company they are buying into. You are providing capital to a vehicle where you have absolutely zero say in how that capital is ultimately deployed. This governance reality typically demands a pretty steep discount in the valuation model to compensate for the lack of shareholder rights. Now, the most heavily scrutinized disclosures are buried deep within the fine print of the S-1 registration statement. When you actually parse through the related person transactions, a fascinating series of capital events comes to light. The filings outline significant related party transactions and capital extraction that happened just prior to the offering. These disclosures raise some really serious questions about capital allocation in the years leading up to this public listing. Institutional analysts are heavily trained to forensically examine these specific line items to gauge management alignment. Corporate governance risk is a massively weighted metric in modern institutional portfolio construction. Understanding exactly where cash flowed prior to the IPO is just as important as projecting where it will flow afterward. And the data here presents a very specific, undeniable pattern of historical cash utilization. The S1 details a jaw-dropping $50.5 million cash distribution over the 3 years leading up to the IPO. That is an extraordinary sum of operating cash to just flow out of the business to a single individual. Distributions of this magnitude directly and heavily impact the retained earnings and overall liquidity of the corporate entity. While private companies definitely have wide latitude in compensation, this shifts the perspective entirely as they transition to public markets. Analysts have to determine if these historical distributions artificially depress past cash reserves. They must also heavily model whether similar compensation structures will remain in place post-IPO. The outflow of $50 million represents pure capital that was not reinvested into the growth engine. It is a definitive financial data point that directly impacts the overall assessment of corporate governance here. And that individual receiving the distribution was Philip Sivalobov. He happens to be the stepson of founder Peter Cancro. Institutional investors heavily scrutinize related party transactions of this magnitude when they are directed to immediate family members. When pre-IPO capital is channeled to relatives rather than being reinvested or used to pay down debt, it triggers massive algorithmic risk flags. Governance models typically heavily discount valuations when familial financial ties are this prevalent in the S1 disclosures. The major concern is whether the board of directors operated with true objective independence during the authorization of these payouts. Public shareholders demand rigorous fiduciary oversight to ensure capital is actually being maximized for all equity holders. This specific disclosure requires investors to underwrite a whole additional layer of governance risk. But the pre-IPO capital outflows definitely did not stop with family distributions. There was an additional $40 million exit check written directly to the company's longtime CFO. Exit packages of this massive size severely impact the post-buyout balance sheet by draining immediate cash reserves. While executives are routinely compensated during acquisitions, the sheer magnitude of these specific cash payouts is notable, especially for a company carrying $2 billion in debt. These lump sum payments require either drawing down on cash balances or taking on additional short-term liabilities. It reflects a culture of pretty aggressive compensation maximization leading right up to the liquidity event. Analysts are going to have to factor these one-time historical charges into their normalized earnings models. They have to ensure that the ongoing executive compensation structure actually aligns much more closely with standard public market benchmarks. Further down the cash flow statement, we find a highly unusual capital expenditure buried in the 2024 financials. An outlay of $41 million was explicitly marked under cash expenditures. An expense of this size stands out as a stark, glaring anomaly in an otherwise totally asset-light franchise model. Remember, a core tenet of the bull thesis is the incredibly low corporate overhead required to run this operation. Therefore, finding a random $41 million capital expense requires immediate forensic investigation by any serious analyst. It completely contradicts the primary narrative that the corporate entity requires minimal capital expenditures. Understanding the exact nature of this purchase is absolutely critical for projecting future cash flow requirements. The SEC strictly mandates precise disclosure for capital assets of this magnitude. Well, the filing clarifies that this $41 million went toward the purchase of a private aircraft. Furthermore, that aircraft was ultimately transferred directly to an entity controlled by founder Peter Cancro during the sponsor acquisition. Public market investors absolutely must factor these historical cash extraction events directly into their governance risk models. The transfer of a corporate asset like a jet to a founder during a buyout is a highly scrutinized financial maneuver. It serves as a stark data point regarding exactly how cash flows were prioritized prior to public ownership. Institutions are going to weigh this historical capital allocation heavily against the forward-looking promises made during the roadshow. These facts are presented in the S1 strictly as governance data points for the market to price accordingly. It provides a really comprehensive view of the financial culture operating right behind the franchise metrics. Taking all this data in, we arrive at the fundamental valuation math. Based on the 317.6 million fully exchanged shares at the $23 midpoint price, the implied equity valuation sits at $7.31 billion. It is extremely critical to distinguish between this equity valuation and the enterprise value. When you take that $7.3 billion in equity and add the $2.1 billion debt load back in, you bridge the gap right toward that $12 billion enterprise value target. The enterprise value represents the true total cost to actually acquire the entire capital structure of the business. The debt is a massive component of what the market is actually pricing here. This mathematical reality shows exactly how heavily leveraged the overall $12 billion figure truly is. Investors buying the equity are essentially taking a subordinate position to that massive debt obligation. Quantitative analysts are looking at this valuation gap incredibly closely. Cavoot's Market Lens analysis actually suggests a recommended entry zone between $10 and $11.50. They have a 12-month target of $14.50 and an invalidation level at $9.50. Quants see value significantly lower than the IPO price, largely due to a combination of the debt load and the required risk premium for the dual-class structure. Algorithmic models heavily penalize equities that lack voting rights and carry these high leverage ratios. There is a very significant disconnect between the underwriter's proposed pricing range and where independent quants see fundamental value for secondary market buyers. This suggests that the IPO is priced for absolute perfection, leaving very little margin of safety for retail and institutional buyers. The quantitative data basically urges patience, waiting for the market to reprice the governance and debt risks post-listing. This vast array of financial data all synthesizes into a deeply clinical risk and reward analysis. The underlying fast casual business is incredibly strong, it's operationally disciplined, and it's capturing market share rapidly. The franchise unit economics are highly enviable and they produce tremendous free cash flow right at the store level. However, the corporate debt load drastically alters the overall investment profile. The insider-heavy capital structure demands intense caution from anyone considering buying at that initial offering price. You are essentially evaluating two completely different entities here. There is the pristine sandwich operation, and then there is the highly leveraged financial vehicle built directly on top of it. The success of the stock will depend entirely on how efficiently management can service the latter using the cash generated from the former. Which brings the analysis right back to the structural tension we established at the beginning of this filing review. Is the most high-profile restaurant public offering in 2 decades a premium bet on a highly efficient operator, or is it primarily an insider cash-out designed to absolutely maximize the exit valuation for private equity and family members? The numbers in the S1 registration statement honestly tell two completely different stories. Your conclusion depends entirely on whether you prioritize the income statement's top-line growth or the balance sheet's looming liabilities. Institutional investors will literally spend the coming days debating which of these realities will ultimately dictate the trading multiples. The market will soon decide exactly what premium it is willing to pay for growth that is burdened by leverage and insider control. This offering is definitely going to test the absolute limits of current public market liquidity and risk tolerance. As this equity hits the New York Stock Exchange under the ticker JMKE, the financial mechanics are now fully exposed. The underlying data provides absolutely everything required to build a comprehensive investment thesis. So, are you buying into a premium growth engine, or are you just buying the sandwich after the feast?